Well, hi, everybody. This is Roger Horowitz. I am the director of Hagley's Center for the History of Business Technology and Society. And thanks for coming to another episode of our Hagley History Hangout, where we talk to people who have done interesting work in the collections of the Hagley Museum and Library. Usually, we talk to researchers who have been engaged in various ongoing projects. This one is an interview with an author who's published their book. Yay! From their research in the collections. There it is. Sean Vanatta. Thanks for coming, Sean, to drop in with us and talk with us about your book. Sean, his position is senior lecturer in financial history and policy at Glasgow, and he has his PhD from Princeton a few years ago. The book, as you just saw, is Plastic Capitalism: Banks, Credit Cards, and the End of Financial Controls, Yale University Press. And he also has published an armful of articles over the years in Enterprise and Society, History Review, and other esteemed journals and all that. He's got plenty of book chapters. He's been very, very active since things. It's also worth noting that not too long ago, he was a fellow funded by the National Endowment for the Humanities in residence at the Hagley Library over one summer, where he cheerfully schlepped down from Princeton every day, where he lived, to come and spend time at Hagley writing and working in the materials there. And I got to know Sean a bit when he was doing that there. That was a great experience there. So now he's going across the puddle to England, and of course we see him all the time. So Sean, thank you again, and congrats on the book.
Thank you, Roger. No, I'm really happy to have a chance to chat with you and continue to reap the benefits of that Hagley Fellowship, where I was able to do a lot of great writing and work, and just really appreciate that experience.
Well, you're great to have it, Hagley, and of course, you and I have talked about this lots. But what I really want to do here is introduce the book to people. Give you a chance to introduce the book to people who are listening. So let's just start with the most basic question of all. Why did you write this book? What motivated you to write this book? I mean, it takes a long time to write a book, especially when it's your dissertation turns into a book. It's over a decade. So what was behind this?
Yeah, I mean, I'd say for any project of this length, and commitment level, there's layers of investment, right? So one part of the story has to do with my own experience with credit cards and kind of getting into a little bit of credit card debt as an undergraduate and having to kind of work through that challenge and trying to think through a bit, what about American society, what about my own experiences made it seem like taking out, three some odd $1,000 in credit card debt was a good idea. And so it's kind of working through that and then seeing in that experience the broader experiences of Americans who have struggled with either with credit card debt particularly, or who have struggled with kind of making sense of the consumer credit economy. And in the book, as I show, have really tried to shape the consumer credit economy to meet their expectations for fairness and for how the economy ought to work. And so it's kind of that pivot from my own story into trying to think through the stories of these other people that really, kind of kept the momentum for the project, is trying to see how consumers, how their advocates tried to make finance work for them throughout the kind of post-war era, and their kind of successes, and then maybe ultimate failure in that endeavor. And then tied to that is my kind of a set of scholarly motivations. I mean, as I was trying to figure out what kind of historian I wanted to be, I was really inspired by Stephen Mihm, who was my mentor at the University of Georgia. He has this amazing book on counterfeiting in the 19th century, and kind of through reading that, I came to see that like finance can be a lot weirder than we might expect, right? It can be really interesting the ways that categories, things like money that we think we understand, that we use every day, actually aren't as simple as we understand. And so I knew I wanted to do something like that, which drew me into the kind of credit card industry as another kind of form of money that we can rethink and come to understand the ways that sort of the government and private actors are shaping the very kind of fundamental media of our financial system and seeing how those, how money changes over time.
Hmm.
And in this case, right, a very kind of private and privately ordered form of money. And so that too is one of the kind of driving motivations through the project is really trying to rethink what money is and how people use it and how this kind of market for finance is shaped by both government action and private action over time.
Certainly money has been one of the driving features of American politics for quite some time. Inflation, deflation, silver, coinage, greenbacks. I mean, this is a long history, and so what you're doing is positioning this book as a story of another form of currency in many
Yeah.
respects. Well, tell me the main questions that you explore in the book itself. And obviously, you've just given us the big question. Sort of how did it come that we have credit cards really instead of actual American currency in our pockets when we go around there? And you just, when you go to a store now and you give them a $5 bill for something which costs $1.49, it creates chaos
Yeah.
because you have to pay change and it's slow and all that. So, your point is very interesting. How this is a different kind of money. It's not just about credit; it's about money there. So we got that big picture. Break it down a little bit. Some of the questions you really interrogate in the course of the chapters of your book.
Yeah, I mean, I think like there's maybe kind of two very big questions and then smaller questions that come out of that. The first is essentially like the business history of credit cards.
Hmm.
So what drives banks to pursue credit card technology in the first place? How do banks determine which strategies within the credit card industry are likely to be effective? How does that sort of spread throughout the industry? How then do banks develop things like the credit card networks that we recognize today,
Hmm.
Visa, MasterCard, to make this technology, which begins very locally, into a national and international um, part of our economy? And so that's kind of one set of questions, and ultimately, really like which banks succeed, which banks don't
Hmm.
succeed, and how do we get to the kind of credit card economy that we know today? And then the second big set of questions is how then do other stakeholders respond? So, kind of fundamental to the book is this idea that, of course, law and the state structure markets. Like we can't have any kind of
Hmm.
markets without regulation, without governance, without trust. And so, how then do
Hmm.
consumers or politicians or other kinds of financial institutions that are competing with banks, how do they use the different mechanisms of government to try to shape this market to meet their
Hmm.
need or to serve their interests? And so there's this kind of again a kind of business history story, and then there's a political history story of how these contests play out, importantly, both at the federal level and at the state level, in legislatures and in courts. So there's this constant interplay between different levels and different kind of locations of governance as the industry develops, showing that like there's no kind of streamlined path, right? It's not just a piece of legislation and then you have the credit card industry. It's a constant tug of war in these different political forums to
Hmm.
shape the market. And so that's a kind of second core
Hmm.
question. Um, and the arc of the story then is one of beginning with a banking industry that's very confined, especially by the regulations put in place during the New Deal. There's a period of experimentation and growth in the 50s and 60s where banks are getting into the industry, thinking in effect that this is a way to innovate around the New Deal's restrictive rules, to develop a consumer finance industry, to develop new sources of profits. But ultimately, there's a really robust consumer backlash that sort of brings credit cards into the tightly regulated system that banks are operating within. And so while credit cards it seemed like a path out of the really restrictive New Deal era regulations, ultimately cards get kind of wrapped into that bundle. So it's kind of a first part story, a kind of movement and counter movement. And then we see in the 70s a reinvestment by banks in the credit card market. Particular players like Citibank become really important. And banks are able to use the kind of quirks in the financial system to get out of to break out of the regulatory barriers, the regulatory confines, and push credit cards to the center of the economy and to make credit cards now, by far one of the most profitable areas in banking. And so it's like a story then of like a movement and a failure then to re-regulate credit cards, although there was significant effort to do so.
That captures the big picture there. Let's say some more about the New Deal. And I say that to, of course, I've read the book, and the New Deal doesn't just anchor the book. I'd say the New Deal helps define the problems that end up being wrestled with for a good 50 years after they're established. So say something about the New Deal and what that system that establishes that remains very resilient for decades.
Yeah, so there's kind of maybe two or three kind of core features of the New Deal that are really important to the book. So the first is the kind of regulation of finance. To some extent, this is a well-known story, right? We have the Great Depression, we have the massive banking failures of the early 1930s. And so there's this major effort during the New Deal to create a regulated financial system that will kind of eliminate that problem. And core to that, as I argue in the book, are three kind of pillars of regulation. So the first is what I call financial federalism. It's this idea that banks will be confined within individual states, so they can't get that big, and that states will be able to regulate banks within their borders. And so states are wrapped into and become critical players to the regulatory structure. The second pillar is industry siloing. So it's this, division between investment banking and commercial banking and insurance. You have the financial sector is kind of broken up, which again limits the ability of the creation of big and kind of systemically important financial institutions, and essentially keeps bankers and other financial players fighting over the borders between the financial services industry and not kind of uniting to get legislation that favors the industry as a whole. And then the third kind of pillar is price controls. So there's a limit both to what banks can pay for deposits, and states limit what bankers can charge in terms of interest, whether to consumers or businesses or in other kind of circumstances. And so together, this sort of regulatory system, on the one hand, makes banks tends to make banks small, it makes banks stable, but it also significantly limits profitability. And so this is really the challenge that banks are grappling with through the rest of the kind of post-war era, is how to generate profits, how to get out of these tight rules. So that's kind of one key facet of the New Deal, and I'm sure we'll talk more about that, how that played out later on. The second is that the New Deal really emphasizes household borrowing as a key engine of the economy. So you see maybe the sort of organic generation of this in the 1920s with the rise of auto lending, with the sort of expansion of home mortgages, with the rise of consumer installment lending of all types. And, people like, of course, Lewis Hyman and others have talked a bit about this. New Dealers essentially, when they're dealing with the Great Depression, think that we need that consumer borrowing to come back if the economy is going to get back to full production. Because this level of the economy, the level that it reached in the 20s, was in part because consumers were borrowing to buy things like cars and houses. And so the New Deal really sort of builds in household borrowing as an essential element in the economic system, in the political economy. And again, that continues into the post-war era. So it makes the kinds of consumer borrowing that happens through credit cards more socially, culturally, politically acceptable. And then I think the third pillar is the development of the welfare state, because things like Social Security for privileged households make them better credit risks. So banks can feel comfortable lending to households knowing that if the breadwinner loses his job or someone ages out of the workforce, there are these systems of Social Security which will enable them to keep paying their bills, even if the kind of the vagaries of capitalism, which might have made them bad credit risks in the 1920s, make them perfectly acceptable risks in the 30s. So you have this kind of these three aspects which then set up both the kind of growth of an expansion of consumer credit in the post-war era, but the very limited participation of banks in that expansion, at least in the 1940s and into the 1950s.
That's good. I mean, this is what I've thought about when I read that in your book there is how this interfaces with the really the support for labor unions. Because once you have labor unions that are able to have contracts and you use the Fair Labor Standards Act to generate guaranteed work weeks, suddenly the blue collar workers can buy things on credit. They can buy things on time because they know they're going to have, and the most important, lenders know they're going to have regular income. And that changes the ability of the blue collar population to get buy things really
Yeah.
through that. But of course, that's a dynamic you're talking about how that buying things on credit and credit as such becomes something that the population becomes familiar with and it's acceptable to have.
Yeah.
All right, so this one thing you emphasize in the book too is how this is a place-based system. I think it's very interesting that this is rooted in federalism. Say something about what you mean by a place-based system, because we're going to contrast what happens later on.
Absolutely. So I mean it's important to remember that like up through the New Deal, banks couldn't build branches outside of the states in which they were located, right? So you had on the one hand, you had state chartered banks. So, Massachusetts or Illinois would charter their own banks. And of course, those state chartered banks couldn't branch out of the state they were chartered in because they were rooted in place. And even nationally chartered banks either had to have sort of one location or eventually could branch within a state if the state allowed branching. But they also couldn't cross state lines. And so you have this system where finance is fundamentally local. In 1945, at the end of World War II, there's something like 13,000 individual banks in the United States. So it's a system where finance is still fundamentally local. And the regulatory structure is shaped so that states, through things like interest rate policy, interest rate regulations, are regulating finance within their borders. And this is really intentional. It's a way to, there's a kind of really fundamental belief that local banks finance small local businesses, that these are the businesses that are foundational to the free enterprise society, that if we have really big banks, well, those are, could be nationalized by a totalitarian government. They'll only support the big corporations. They won't support little people. And so there's a kind of deep ideology about smallness in finance that then is also tied into the importance of local financial institutions to the local economies. And this then means that, in my particular story, as the credit card industry begins to develop in the early 1950s, it's because banks are rooted in specific places. They have close ties to the local retailers and merchants in their communities. They see in particular the expansion of large national department stores, which are able to offer credit, which often comes on kind of metal cards, which are sometimes called credit cards at the time. It's those sort of local community ties out of which the credit card industry, the bank credit card industry develops. And through the mid 60s, that's kind of how it operates, that it is banks tying into merchants in their communities, creating local credit networks in a suburb or in a central city. And so it's out of out of those sort of local connections that the credit card industry begins to develop.
And this is, I mean, to me, what's interesting, again, thinking as a historian, that we emphasize that one of the great values of the nation state is creating a unified national market. Because so if you're selling goods in New York or that come from Massachusetts, you don't have to pay a tariff. Well, this almost is not a national market. I think that's your point, that the market is, there's 50 markets, well, maybe 48 until we grow up in for states that are dealt with walls, pretty steep walls between each of these places. I just think that thinking about this almost geographically helps understand the nature of the transformation you're describing. So now let's talk about how that changes. Take us through some of the steps about how this place-based system, fragmentation of the market changes over the course of a few decades.
Yeah, so the kind of critical transformations begin in the mid 1960s. So at that time, you have a number of small kind of local credit card plans. And the big one, again, in terms of banks, is the Bank of America. At the time, the Bank of America is the largest bank in the United States. It's only in California, but California has unlimited branching. So Bank of America has something like 800 branches across California, and they've developed this big credit card network called the Bank America card. And in the mid 60s, Bank America executives begin to think that maybe they can spread the Bank America card nationally. And their core problem is that they're trying to compete with American Express, which is a travel and entertainment card aimed at business executives, to help them travel and entertain across the country as they're, traveling salesmen, entertaining clients, that kind of thing. And Bank of America, which has built a network really to appeal to female shoppers, domestic consumption, is trying to layer in these travel features, but because they're only in California, they're really limited in what they can do. So they begin to imagine a national market where they can recruit other large banks that will join their network. And this sparks a kind of major counter response. Lots of banks don't want to partner with their biggest rival, Bank of America, so they then create what ultimately becomes the Interbank Card Association and MasterCard. And so you see kind of at once, right, a national system of credit card networks. You can take your Bank of America card from California and go shopping in New York. You can take your MasterCard from New York and go shopping in Florida. But the banks themselves are still fundamentally local. So if you're a Bank America card affiliate, you're signing up consumers like your customers in your local area. You're reaching out to merchants in your local area and signing them up. You're partnering with even smaller banks, which will sign up merchants in their even smaller communities and will send you lists of customers that you can then offer credit cards to. So there's this interplay between trying to create kind of nationwide brands, nationwide markets to compete with things like American Express, with Diners Club, which is also prominent at the time. But it's still fundamentally rooted in this local process of network building, in the local relationships that banks have, both with their kind of merchant and business customers on the one hand, and with consumers on the other. And so that's kind of the first transformation. And so then you have what become complicated questions about complicated legal questions, which the book takes up. Essentially, as we've talked about, interest rate policy is set at the state level. But if you take your credit card from California to New York, or in the cases the book is most interested in from Nebraska to Iowa or Iowa to Minnesota, or if a bank in Nebraska issues cards into Iowa, whose law applies, right? If states regulate credit card interest rates, which state's law applies when you cross state lines? And so it's those kinds of legal questions where the Supreme Court is trying to create a national market, is trying to create uniform policy, where the kind of local begins to break down in some ways and not in others. What I mean by that is that kind of crucial hinge of the book is this thing called the Marquette decision. And basically, there's a bank in Omaha, Nebraska, the First National Bank of Omaha, which is issuing credit cards to consumers in Iowa and Minnesota and South Dakota and a bunch of other states. And what the First National Bank of Omaha wants is uniformity, right? They don't want to have to calculate different interest rates depending on where the consumers are, where they're using their cards. And what the states want and what the Omaha's competitors want is diversity, right? Iowa want Iowa law to apply to Iowa consumers. Banks in Minnesota want Minnesota law to apply to Nebraska banks that are competing with them in Minnesota, right? So there's these different visions of how state regulation is meant to work. And what the Supreme Court ends up saying is like the state where the bank is located, that's the law that matters. And at the time, this is useful, and it's certainly useful for the Nebraska bank, but it's still not obvious how important it's going to be because banks are still rooted in place. So these sort of laws like interest rate restrictions are set by the local legislature. Banks and consumer groups and other stakeholders within individual states are negotiating these laws back and forth, legislative session after legislative session. And so as long as banks are stuck in Omaha or in Minnesota or in Iowa, then it's important, as a kind of legal question, but it doesn't really reshape the market as such because banks can't just move to a state that has less restrictive rules. And so for a time, that's still like it's a case that we think of as really important, but at the time is not seen as that important.
You're talking about the Marquette decision?
The Marquette decision,
Yeah, yeah,
absolutely, yeah.
yeah.
And so what makes it important is Citibank. And so Citibank is kind of like, I don't want to say they're the villain of the story, Roger, but they are. Citibank is, they're just a different kind of bank. So I've tried to describe this kind of very local financial system, and that really is the domestic picture in the United States. Citi, for example, they're second or third largest bank in the United States, but they can't build branches outside of New York State. They're really mostly confined to New York City. But they and sort of the largest banks like them, Chase Manhattan, Bank of America, are huge international players. So part of the kind of post-war story is the dramatic expansion of US banks abroad on the back of like the Bretton Woods system, the dominance of the dollar as the global currency. And so Citi has the largest international branch network, and Citi bankers in their international operations become really good at kind of manipulating regulations across space about booking, taking a financial transaction that maybe happens in Germany, but booking it in, Luxembourg where there are lower taxes or fewer regulations. And so as they learn to manipulate financial space globally, they then take that experience back into the United States. And they also, although they're very profitable globally in the 60s and into the 70s, they face rising international competition as Japanese and European banks become more important players globally in the 70s. And so in the mid 70s, Citibank turns its attention back to domestic finance, and they begin to think about um, I don't want to call it a problem, but maybe a sort of contradiction in the way the credit card market is set up. They start to think like, well, we have these credit card networks, right? You have a Bank America card or you have a MasterCharge, and that's the card that you associate with the payment system, right? That's the card you use. And you can use your MasterCharge in, again, New York or California or Chicago or wherever. That card is issued by a bank. But do consumers really think about that? Do they associate their credit with the network or with the bank that issues the card? And do they understand these relationships that link the kind of local credit sort of system that the bank creates with the national credit system that the network creates? And so in the late 1970s, Citibank begins to send cards nationally on the assumption that consumers don't really notice or care about the difference. And they do this because they think eventually, there will be a lifting of the regulations that keep banks within states. They think that credit card technology and card technology more generally can make the card itself a kind of mobile bank, a sort of center of consumer finance. And so they mass mail cards across the country. And this then begins a massive kind of marketing campaign that other big banks join in on as they all start to create nationwide consumer credit businesses, where previously, again, they had been really kind of local before that. And so it's that expansion and eventually Citibank's relocation to South Dakota, which breaks down this very locally organized credit card system and creates the more national, more concentrated, higher interest rate system that we recognize today.
Exactly. You have this nationalization of it. And at one point, you talk about how this is turning credit cards into a commodity. In other words, rather than a sort of a branded good associated with a bigger bank, it becomes simply, if you will, mass produced,
Yeah.
where the nature of the card becomes relatively unimportant, the bank that it comes out of, because it's nationalization of the system. And I think that's a very nice point. Just turned into something denatured, if you will, from where it comes from.
Well, I
Um,
think part of it is just that like in the from the 60s to the early 70s, banks come into the credit card industry because they see this as a way to differentiate themselves from their competitors. And they want the card to be really kind of locally oriented. So in the late 60s, you have all kinds of different credit card brands that are really local. If you can, I don't know, see behind me, right? You have like the Midland Charge Plan, which is Marine Midland in upstate New York. There's the First Bank card, which is from Seattle. You've got the Pittsburgh National Charge card, right? So you have all of these locally branded plans, and banks are thinking about all kinds of new services that they can offer through the credit card. But what happens is as the regulations, as consumers kind of respond to this and seek to regulate the industry, they introduce, you get the Truth in Lending Act, which has complicated terms that banks struggle to comply with, so that if they're introducing new terms, they risk sort of massive lawsuits from consumers. You have bans on certain credit card marketing practices. You have all sorts of this whole suite of consumer regulations that come online in the early 70s, where banks basically say like, well, we can't actually innovate anymore. We can't offer new services through credit cards because we put ourselves in legal jeopardy. And so there's this kind of, again, this first process where they become a commodity through regulation, and that's what consumers seem to want, right? They want credit cards to be a simple, easy to understand product. And it's only as these bigger banks begin to then try to develop new technologies, things like ATMs, for example, other ways to access finance through technology, that they try to differentiate again and create kind of innovate in new ways that will make cards, again, bank specific. And so there's always this tension between kind of a homogeneous network where the bank is unimportant and kind of bank specific products that will enable the bank to maybe kind of use the network to
Hmm.
promote its own um, interests. And so it's these, again, these kind of tensions which really define the industry throughout. And you can see it today. I mean, it's like what consumers wanted was simple, easy to understand interest rates. And you see bankers are always kind of changing credit card terms to market cards in new ways, which you can see as beneficial to consumers, like we're trying to think through consumers' needs and offering them products that suit their needs. Or you could think of it as exploitative,
Mhm.
saying like, well, we know that consumers don't really understand, or we know some things about behavioral economics where consumers are likely to take the low upfront rate but not change cards once the rate increases. So there's, a kind of tension between uniformity and simplicity and novelty and innovation and exploitation and, that kind of thing.
Well, I mean, it does again to think back on this as a form of money. It has the parallels to the bypassing of the state bank issued green forms of money, if you will, to developing a national currency, and where the national regulatory process nationalizes these things, standardizes things, and that changes the market, facilitates certain kinds of practices. So what you're saying here is that in a way, is the federal government stepping in to regulate these credit cards that generates a push towards nationalization of them, not nationalization in the sense of taking over, but nationalizing these cards and making them more standardized as a form of money, if you will.
Yeah.
Now,
Yeah, I think that,
consumer, yeah, go ahead,
yeah.
go ahead.
No,
Well,
good.
what's the role of consumer demand in this? You mentioned it a couple of times. Why don't you pull it out? And because your story, as you say early on, is a story of really countervailing pressures, and consumer demand is in there throughout. So pick that out. And how is consumer demand playing a role in this transformation that you described?
Yeah, so I'd say, yeah, several layers to that question. So one is that there is this consumer expectation among affluent consumers that credit is sort of like a right. Like if you're a well-to-do consumer and you go into a store, you should expect to be able to buy on credit. And this is a kind of 1950s, 1940s, 1950s idea where large department stores and large retailers are able to offer this service. When you use it, what was then called a charge account as a consumer, you're not paying interest, so you have 30 days to pay off your purchases. And so, stores would offer this as a marketing tool to sell more goods, right? The idea, of course, is that if we give you this credit, if we give you 30 days to pay with no interest, you'll buy more things and we'll make more money. We may lose money on the credit side of it, but it's a small expense if managed well. And so it's this credit expectation that small stores fail to meet that's initially really the driving motivation for banks to get into the industry, and it's the way that they try to convince merchants to take cards. And importantly, like in the 50s, that's the kind of business model for banks. So banks are also not charging consumers interest. They're charging merchants a fee every time a merchant, every time a consumer uses a card. So it's usually 5, 6% of the purchase price. So if I spend $100, the bank will take $5 out of that. And that focus on merchants, it's a way to kind of like solve this problem that you have with credit cards, where you need enough merchants to appeal to consumers, and you need enough consumers to appeal to merchants. And banks focus on merchants and ask merchants to recommend consumers as the way to build these markets out. So it's a kind of merchant-centered approach. In the late 50s, Bank of America goes the other way. Bank of America has 2 million depositors across California, and they mass mail credit cards to all their depositors. And this way, it's like, well, now all the consumers have credit cards, so merchants, you need to sign up for this plan because your customers are going to expect this, right? They're going to come in and say, why won't you take my credit card? And so it's a way to kind of coerce merchants to participate in what is a rather expensive operation. So that's kind of one story. It's the story about like, what do consumers expect and how is that expectation met through the credit card networks, and how are banks kind of using those expectations to grow their networks. The kind of next part of the story is that then once there's a massive entry of banks into the market in the mid 60s. So as I said, right, Bank of America nationalizes the Bank of America card, other banks respond. There's like, 65 banks issuing cards in 1965. There's more than 1,000 in 1970. So there's this huge escalation. And the way that banks try to grow the market is they all mass mail credit cards. So there's 100 million cards getting mailed out over this time period. Consumers are deluged with plastic coming in the mail. And this then sparks a kind of different response where consumers now begin to see cards as a threat. It's a threat to household finances. So they're really worried about interest rates that banks and other card issuers are charging. It's a threat to their kind of financial safety. So they're worried about people stealing cards out of the mail and running up bills on their account. It's a threat to kind of household relationships. They're worried, the husbands are worried that their wives are getting cards from these banks. And so this is then what creates this consumer backlash in the 60s to regulate cards. And so it's both, again, a kind of issue of price and kind of economic fairness, and then also about safety.
And just break it a second. You make an important point for this mass mailing, that it's not like now we get a credit card offer and you have to activate the card. The cards were ready to use, which I didn't realize. And so the opportunity for fraud is staggering. And you have a very nice chapter on what that means. So fraud is a big part of this dynamic where consumers are reacting against, really theft of their resources.
I think like the fraud part is really like, I don't know, maybe my favorite part of the book. And you can see the clear link back actually to Stephen Mihm and the counterfeiting stuff there. Where on the one hand, right, yeah, you have consumers who are worried about fraud, who are worried about how that's going to affect them being billed for things that they didn't buy. But of course, banks also don't want fraud, right? So it's then trying to figure out what are the market rules that we can put in place that will limit fraud. And so on the one hand, banks are trying to make merchants the frontline sort of police. So, scrutinizing the signature and calling the bank, if charges are over a certain dollar amount. Banks are trying to make consumers protect their own cards by pushing liability onto them if the cards are lost or stolen. But banks are also going to the government and saying, we need really strong anti-fraud laws. We need you to devote policing resources to protecting these cards. And the government, especially the federal government, is just like, no way. You guys are mass mailing millions and millions of credit cards. You have virtually no protections for these cards. Like the FBI is just not going to come in and save you when you're experiencing millions and millions in fraud losses. Like you did this to yourselves.
Well,
And so
it's a good example of how you describe this as a fits and starts, because it's sort of like, didn't you guys think about this as you don't address that, but the answer really is no. They didn't really imagine that sending out lots of cards in the mail could produce fraud, which, just shows that these are not the kings of the universe. These are people who may be somewhat limited in their awareness of what might happen in that kind of scenario.
Yeah, I mean, it's, like a sort of theme or thread in the book that's, you know, I think is important is trying to think about who these bankers are, what their primary business is, which is engaging with and lending to other businesses. So we call commercial banks because they're meant to be lending to businesses. They're not really meant to be consumer or household lenders. And it's through this period that they begin to do that.
Hmm.
But as you say, like the people who come in and run the credit card operations in some of these banks just have no experience in this kind of lending. They have no experience thinking through the kind of repercussions of what they're doing. And so, yeah, you see just like massive fraud losses, really the banks totally struggling to figure out what to do. There's this major episode in Chicago where all the banks are rushing to get into the market because they're afraid that whoever gets a credit card into consumers' hands first, like that consumer is going to move all their business to that bank. And so they're mailing, millions of cards right before Christmas. Uh, the post office is staffed by temporary employees, many who end up having ties to the mafia. All these cards get stolen. There's huge amounts of fraud. And so a lot of the banks then have to cancel all the cards and reissue them because there's just like this fraud problem that they can't deal with. And this continues throughout the late 60s until Congress bans unsolicited card mailing in 1970. And to some extent, the banks are just like, thank God, like we felt like we had no choice because of this competition, because we felt like if we weren't the first in the market, there's no way for us to recover and we'd lose all of our consumers before we ever got a start. It's like now we can actually build this industry in an orderly way without all this chaos. And so that's a major part of it. But as I said, like it also sparks this huge consumer backlash and this effort to wrap credit cards into the same regulatory restrictions that limited banks in other areas. And so that's part of it. And I think like one thing, it ties to something you mentioned earlier that I think is important and I didn't really expect, which is the role of labor unions in this in particular. Because as you say, right, like unions see access to credit as important, but they really are focused on things like auto loans that then help build cars, which employ unionized people. And they're really resistant actually to things like credit cards, which enable you to sort of substitute your wages with this extra form of money through credit. And they're really eager to restrict credit. And what they think is like, well, if we limit the interest rates that banks can charge, then we're really going to limit the availability of this kind of credit. And it will make workers more likely to fight for higher wages. They'll still continue to see like the wage fight as the important fight if we limit this access to this kind of convenient revolving credit. And so that's a kind of core part of this effort through the 60s and 70s to maintain restrictions on interest rates because it will then limit the amount of debt that consumers can take out. It will limit who can access credit. And they do this really like thoughtfully and explicitly as they're trying to institute these state level rules.
Well, let's bring this to the end of the story, which is really Citibank in South Dakota. Tell us what happens there, and Delaware, of course. And along the way, maybe if you found some sources at Hagley that related to this, to the denouement, really will, of how the cards become fully nationalized.
Yeah, so the kind of key thing here is that, as I said, in the late 70s, 1977, Citibank begins this nationwide campaign. So Citi, it's based in New York. They were a master charge affiliate. They had 100, or excuse me, like a million, maybe 2 million master charge cardholders in like New York, Connecticut, and New Jersey. So again, really local, right? But they begin this national mailing campaign where it's not they're mailing cards, but they're mailing like pre-approved credit offers. At the time, what had been Bank Americard is changing its name to Visa. And the city executives sort of see this as an opportunity to just mail, a little flyer that's like, here's the Visa card that you were told to expect. Because consumers understand that Bank Americard is becoming Visa. And again, they're not really thinking about which bank is issuing the Visa card. So they know that this change is happening. Here's the letter that tells them to claim their new Visa card, and that's what they do. So Citi goes from having no Visa cardholders in 1977 to more than 4 million. And they become the largest credit card issuer in the United States at the time. In that moment, what's really important to understand is that state level interest rate rules restrict what banks can charge. So Citi can charge 18% interest on the first 500 of a cardholder's balance, and then 12% after that. Also, state level rules restrict annual fees. So Citibank cannot charge cardholders an annual fee for having a credit card. So they have a really sort of limited revenue stream from their cards. At the same time, Citibank is funding its credit card program through through kind of interest rate variable markets. So they're selling commercial paper, they're raising funds in Europe, actually, in what are called the Eurodollar markets. And this is a really common practice, and this ties into what one thing I found at the Hagley, Roger, where from the very beginning, this is how banks are funding their card plans. And this is important because the way that the regulatory system is set up, banks are meant to pay a fixed amount for funds through restrictions on what they can pay depositors. And then they can charge a fixed amount for funds through interest rate restrictions. And so there's meant to be a gap between what they pay for funds and what they charge for funds. And that's where banks generate profits. But because banks finance their credit card business in variable markets, in active money markets where the price of money rises and falls over time, it creates this problem of interest rate risk, where if market interest rates go up and the rates that banks can charge consumers stay the same, credit cards can go from being profitable to being very unprofitable because banks might be paying more for the money that they're borrowing than they can charge for the money that they're lending. Bankers understand this problem. What they try to do is they limit the amount of credit that consumers can take out, and they limit the length of credit card contracts. So you're meant to be repaying your credit card balance over time. This is how it kind of all works in the late 1970s. And when Citibank goes into the credit card market in the 70s, credit card rates or market interest rates are sort of high because there's high inflation. But Citibank thinks that over the long term, rates are going to go down, and so their cost of money will fall, even as what they can charge consumers stays the same. The problem with that assumption is that in 1979, Jimmy Carter appoints Paul Volcker to be chairman of the Federal Reserve. Volcker, who's bent on wringing inflation out of the economy, raises market interest rates to unprecedented levels. So all of a sudden, Citibank is paying much more for the money that it then is lending. So it's paying 20% in financial markets to borrow money that it then lends to consumers at 18% or 12%. And so all of a sudden, this effort to build this nationwide consumer credit market threatens the sort of very viability of Citibank as a business. And so what they begin to do is try to find a state that has lighter regulations than New York. They try to convince New York to lift the regulations. Essentially, the legislature and the governor tell them no. They shop around in a variety of states where the legislatures are open. They're choosing essentially between Missouri and South Dakota, and South Dakota ultimately invites Citibank to open a subsidiary in South Dakota. And so that's enables Citi to move to South Dakota, and in doing so, essentially eliminate interest rate risk as a problem in credit cards and eliminate the ability of states to regulate consumer interest rates. Because once banks show that they can move, then states kind of rethink the regulatory calculus. It's no longer a sort of political battle between consumers and banks that's confined within the states, that banks have to sort of negotiate year after year with consumers and other stakeholders in their state. Banks can leave and they can take the jobs with them. And so what had been this sort of place-based regulatory system crumbles in the face of banks saying, we'll go to South Dakota, we'll go to Delaware, unless you change the rules.
And that's where we are today. That's
where we are today.
That's essentially that's a part of that important restructuring. Sean, thank you for this quick tour of your book there. It's a very rich story. There's some wonderful sketches of these bankers, which I think reinforces Sean's point about these individuals actually do matter at certain points in the story. It is a story of mistakes, it's a story of initiative. In other words, it's fairly accurate to the kind of messy picture that historians like to describe. So thank you, Sean, and I hope all of you will go take a look at this book.
Thanks, Roger. I really appreciate, yeah, again, the conversation.